The challenge for us, Mr. Speaker, is how do we maintain macroeconomic stability in a very uncertain environment in which we live. The growth and transformation of financial markets in recent decades has seen increased volatility of exchange rates and capital flows. Global commodity markets now account for significant fluctuations in prices for energy imports, mineral exports, and food supplies. The macroeconomic environment facing South Africans through interest rates, exchange rates, inflation, and credit conditions can be destabilized by these international shocks. So once again, there's a prospect that something that has nothing to do with how we manage our economy could act as a disruptive factor. The macroeconomic policy task is to provide a stable and predictable economic environment by offsetting such shocks as far as possible. Our monetary policy, designed to target inflation, has been conducted successfully by the South African Reserve Bank, achieving the current low rate of inflation and interest rates. Fiscal and monetary policy will continue to work in partnership. Monetary policy conducted by the Reserve Bank will continue to be focused on controlling inflation, and we will continue to ensure that fiscal policy is countercyclical within a sustainable long-term framework. Movements in the exchange rate affect different sectors of the economy in different ways and present difficulties in macroeconomic policy for many countries. Recognizing the impact of the rand's strength on manufacturing industry in particular, we announced measures in October during the MTBPS to moderate the potential effect of capital inflows. Firstly, we said that foreign exchange regulations were amended to permit greater foreign investment by South African institutions and individuals. Second, we stepped up foreign exchange purchases by the Reserve Bank, which have helped to moderate upward pressure on the rand. As a result of these policy adjustments, and in line with shifts in investor sentiment globally, the rand depreciated from December 2010 to February 2011 by about 10% on a trade-weighted basis. During 2010, South Africa received net inflows of 92 billion rands in liquid foreign capital, which contributed to the upward pressure on the exchange rate. Since December last year, however, South Africa experienced some reversal in these capital flows. Along with uncertainties and volatility in global financial markets, this contributed to the depreciation of the rand. Furthermore, the increases in oil and food prices I referred to earlier pose significant risks to the inflation outlook, both globally and domestically. Government will continue to assist the Reserve Bank to accumulate foreign exchange reserves when market conditions are favorable and engage in foreign currency swaps to moderate the effect of capital flows on the exchange rate. In 2010, for example, we spent 53 billion rands assisting the Reserve Bank and using some of its own resources in order to balance out this volatility in the rand. Overly rapid currency depreciation carries risks to macroeconomic stability, however, and so we expect the Governor of the Reserve Bank to be vigilant in monitoring inflationary pressures and ensuring that monetary policy is effective in meeting our inflation targets. The credibility of monetary policy in achieving our target inflation range, combined with our commitment to fiscal discipline, are important foundations for moderating exchange rate volatility, which in itself is important for better growth in South Africa. Changes in the volume and direction of capital flows may be significant over the year ahead and are largely beyond our control or influence. We will allow the actions announced in the MTBPS to have their full effect and continue to monitor capital flows. Other countries also experienced high capital inflows in 2010. Several, including Brazil, South Korea, and Thailand, introduced tax or regulatory measures to deter those investment flows and currency speculation. We have examined these options and their impact and will continue to monitor the adjustments made in other countries while recognizing that circumstances vary from country to country. National Treasury is very cognizant of the risk of financial instability and currency volatility that can arise from large capital movements. If necessary, appropriate steps to moderate these effects will be taken together with the Reserve Bank.